My name is David Stevens. I'm the CEO of a company called Affinity MacroFinance. We're raising capital and hope to launch by the end of the year. We have a new paradigm for development, basically. Usually, over the last 50 years or so, development has generally meant exporting capital from developed countries into developing countries. We have some really good news. We found about a missing $3 trillion sitting in those developing countries that most people aren't aware of. $1 trillion of it is in local country pension funds. And of course, you'd expect that some of the higher income developing nations like Brazil and Mexico have a lot of money in their pension funds, but you might be surprised to know that a country like Ghana has over $1 billion in its pension fund. And then there's another $2 trillion or so in insurance company assets that exist in these countries. We haven't surveyed the banking sector, but I'm going to guess there's probably another $2 trillion there. So there's probably about $5 trillion sitting in poor countries around the world, developing nations, and almost none of that money is being used very well for the development of those nations. And that's what Affinity MacroFinance is all about. So the trick is to utilize it prudently and to utilize it well. What happens in a lot of these countries is that the government regulates local pension funds, and they also regulate the financial sector. And they tell these companies, we don't want you to take currency risk, so we want you to invest it in our country. And we don't want you to take much credit risk. So when you invest it, say, in bonds, they should be highly rated bonds. And the problem is, if you're looking around Ghana, for example, and you've got $1 billion in your pension fund, and you want to invest in AA or AAA rated Ghanaian local currency bonds, there aren't any, except for government bonds. And so very often what these pension funds do is they buy government bonds, and for the pensioner who's a part of that pension system, it's like having their whole retirement account in a U.S. Treasury bill. They're earning the lowest safe rate in the country. They're not losing money, but they're also not making money on their investment. So our premise is, well, what if we could help those countries structure productive ways to use that money and provide a AAA rating on the credit because we structure it and work with it and are comfortable with it. And if, let's say it's a green energy project, if the green energy project can't meet its debt service payments, then our company, Affinity MacroFinance, steps in and makes the pension fund whole on whatever might be missing. The trick, of course, is not to have that occur very much and to structure really good transactions. Think of us as sort of like a corporate version of your parents co-signing a loan for you. When you're 22 years old, you're earning an income, you can make the payments on your house, but the bank won't lend you the money, and the parents come in and co-sign the loan, and suddenly that opens the door for you. You have access to credit, and by the way, when you get credit, you get it at your parents' lower rate of paying interest than your own at the age of 22. That's what we do. We, in effect, co-sign or guarantee bonds for developing markets, local currency bond markets for projects in those countries, for a whole plethora of development projects. So, for example, we could support a microfinance institution raising new funds to make new microloans. We can support development of hard infrastructure like roads, airports, schools. We can provide financing for healthcare. Our basic scope is to finance essential public services and infrastructure in these countries. And there's a model for this business that existed in the United States. Unfortunately, it stumbled in the subprime crisis. Last time I checked, there aren't any subprime loans in Ghana. And so we think that we have a better business model, and we're looking to try to catalyze that local currency and use it productively for the development of these nations. It's a broad array of entities that would use financial guarantees like this. They're often public-private partnerships. For example, in most developing nations, an airport project would be concessioned out to a private sector firm that operates it on behalf of the public sector during a period of time because they can bring the financial resources to bear to operate, to construct and operate the airport. So our client base is a mixture of private entities, public entities, and so on. The traditional development agencies have trouble doing this kind of financing A development agency typically raises funds in its own local currency, dollars or euros or Swedish krona or something like that, and doesn't have the ability to lend money in local currency without taking an enormous amount of risk for itself. So what we're trying to do is provide that missing part of the development finance puzzle, the local currency thing.